Good morning, ARMR Insiders and everybody joining our morning meeting this morning. Glad to have you. Let's go over the stock market crash that's unfolding. We're going to talk about what we have done to prepare for this, why it's happening, and what we will be doing. So we're going to break it down into those segments of this discussion for the morning meeting. I like to say this is a virtual hedge fund. Okay, so you're a portfolio manager sitting on the desk right now. It's the morning meeting. We're all going to go out, sit down in our stations, and do battle when the market opens at 9:30. So let's get our strategy ready, figure out your risk tolerance, your goal, and execute that strategy during the day. You have to be the smart money. I'm going to share my information with you and how I'm positioning my portfolio based on my risk tolerance and what my goals are for my portfolio and for the portfolios that I manage. And then you figure out how that shakes down for you and then execute your strategy with blinders on. That's the only way to get through markets like this. Okay, so let's talk step by step. First of all, what have we done here at the ARMR report at ARMR Investing for our virtual hedge fund? 2 weeks ago, the ARMR Risk Monitor went red. The Risk Monitor is made up of 10 indexes with algorithms we've written for the volatility of each. And when those 10 indexes are all saying the same thing, you hear me say confluence is king. And if that thing is bullish, then we have 100% invested. All the indexes are going like this. They all show us the same footprint. That happened last November as an example. So let's look at the S&P, okay? So here's the S&P. We'll break it down into the risk monitor colors. Right here was the big risk on green signal at the 200-day moving average last November. That's when confluence was king. Everything, every index telling us the same thing. We loaded up. We had a great run, okay? 2 weeks ago, the risk monitor went red, okay? That's that pink box right here. There's your down arrow, okay? That's when the risk monitor went red. Now the market is crashing. Let's explain what that means. 2 weeks ago, I said to you, look, we're not getting any confluence. Some indexes going one way, some indexes the other way, and that's generally a sign of distribution. Now, there was this ridiculous debate, and I did my best to discuss it with an open mind. But the simple fact is, there is no such thing as rotation. It's something they teach at university that doesn't happen in the real world since, I don't know, the last decade. Rotation might have worked years ago in your granddad's stock market. It doesn't happen today. Things are highly correlated. When the market begins to sell off, everything goes down together. There's no place to hide except for maybe the three places that I'm going to talk about in a minute where we have our capital. Those are just the facts of the case, and they are undisputed. Anybody telling you the last couple of weeks, hey, money's rotating into small caps are going to go up with the market going down. It never happens. It doesn't happen. There's a couple weeks where it looks like it's happening, and we talked about it on the desk, and you can try to take a shot if you want, but you have to use tight stops and not argue with the market when it starts to go down. Because when it goes down, everything craters together. Bitcoin's down, what, almost 20%? 20% right now over the weekend. 20% down on Bitcoin. Bitcoin is a risk-on asset. It's not a hedge. It's not gold. And to make matters worse, they created ETFs on Bitcoin so that days like this will unfold. The last thing you wanted as a Bitcoin investor is ETFs. You wanted it to stay in the shadows. When it comes out into the light, the government controls it. Big institutions control it. And here's the wipeout Bitcoin's trading at 51,000 or 50,000 or something. Sorry. As I'm talking now, it's in 40,000, 49,000 right now is where it's traded. Okay. Nothing survives when risk off plug is pulled. Everything gets sucked down. So when the risk monitor goes red, it doesn't mean that every time the market's going to crash, but that is the beginning of a very dangerous market, and you have to protect however you wish to do that. So what have we done in our portfolios? I like to say that we are sleeping on a pillow of Treasury bills. We have a lot of Treasury bills in our entire account structure with a better than 5.3% yield. That's an easy place to hide. When interest rates are 0%, it's hard to hide there because you're not getting any return. Man, at better than 5%, I can hide there all day. We've had a big year. First 6 months of the year. It's a great year. Take that, put it in Treasury bills, collect over 5% the rest of the way. I don't have to do anything. I can go take a vacation, take a break, let the market sort itself out. So that's the pillow Treasury bills we're sleeping on every night. And we added a blanket of Treasury bonds last week. Macro funds got about a 30% allocation to Treasury bonds. Special Situations Fund only has one position in it, and it's TMF, triple Treasury bonds. We're having a pretty big morning. Markets imploded. Treasuries are up Treasury bonds are up another almost 1.5%, triple that in the Special Situations Fund. That's the only position we have. And it represents something like 25% of the portfolio. And then triple it. That's all we've got in the portfolio. And I am snuggling a teddy bear of gold. I have a gold position. Gold's down right now. It's down 2+%. Let me tell you something about precious metals. If you weren't, none of you, well, some of you were with me in 2008. So I've managed money for a bunch of you, and some of you were with me in 2008. You remember how we made it through 2008, and we made money in 2008. Much in the same position. A lot of Treasury bills, a lot of gold. But gold was difficult when the market was crashing. It would go down with the market, and then it would have massive resurgence as the weeks progressed. And when we got out of the year, gold and our silver and our gold mining positions ended up making us a lot of money, but not while the market was imploding. So I'm not surprised at all that gold's down 2.5% today. Everything goes down. Treasury bonds, a big upstick. Treasury bills, I'm collecting interest. That's how we're positioned. So why is this happening? Let's talk about why this is happening. Okay. And by the way, I'm happy to answer questions today. So if you've got any questions while I'm having this conversation, feel free to put it in the comment section, and I'll get to the Q&A sector of this discussion. And we're going to talk as long as we want. I'm not making any trades first thing in the morning as the market's collapsing. I'm not looking for a carry trade early in the morning. I'll explain the ARMR carry trade in a minute and what my strategy is there. So if you've got questions, feel free to put them in the comment section and I'll answer them. Okay. Why is this happening? I wouldn't have the hubris to pretend that I know the answer to that question. I'm going to share with you some of my thoughts, and we'll see why. It'll come out over the next series of days, weeks, and months. But a couple weeks ago, I did point out to you that the yen carry trade was unwinding. And when the yen carry trade unwinds, it's risk off for all assets. Let's explain the carry trade real quick, okay? Institutions, hedge funds. Does anybody remember long-term capital management of 1998 that created the Asian crisis, the Asian contagion? Do you remember that? That was the yen carry trade, unwinding. So institutions, hedge funds, whomever, borrow yen, sell the yen to buy dollars, and then buy U.S. assets. It can be Treasury bills if they're very conservative. So if they only cost, I'm just pulling numbers out of a hat. If it costs 2% to borrow the yen and you could buy Treasury bills at 5%, you're going to clear 3%. That doesn't seem like a lot, right? 3%, what's the big deal? You can leverage that. In the infinite wisdom of Wall Street, they allow you to leverage that. Now, in 1998, I think they could leverage it like 10 to 1. I don't think they're allowed to leverage it 10 to 1 anymore. I don't know. I'm not up on that information. But the leverage is there and it's large. Okay? So all of a sudden, 3% is a lot when you leverage it. And that trade works even better if the yen's going down in value versus the dollar, right? Because you sold yen and bought dollars. Eventually, you'll have to buy those yen back to give the yen when the carry trade unwinds, right? So if the yen's down versus the dollar, you're making money on that currency transaction and you're collecting your yield. Then guys get greedy and they say, well, I don't just have to get 3% net in my Treasury bills. Let's go buy the S&P 500. Let's go buy the Hateful Eight. Let's go buy the NASDAQ 100. And you're doing it on leverage, okay? So what happens is something triggers the carry trade to unwind. I shared with you a chart last week of the I don't think I have it with me right here, but of the Bank of Japan raising interest rates. And it goes back to 1987, I think. And every single time the Bank of Japan raises interest rates, it led to a worldwide recession and a market collapse. It's crazy. Every time. And they raised interest rates over the last 6 months. And what does that do? It reverses the carry trade. Okay? So what happens is money starts flowing the other way as people scramble to get out of their carry trade. Because if you've borrowed yen to buy dollars and the dollar goes down and the yen starts to skyrocket, you're screwed. You got to buy the yen back higher. So you sell whatever assets you bought, Bitcoin, gold, silver, NASDAQ, S&P, whatever, and you panic to get out. And then it looks something like this. This is what it looks like. Okay, this is the carry trade unwinding. This is the yen versus the dollar. And when it's going down like this, it means the dollar's collapsing versus the yen. The yen's skyrocketing. Utter collapse. Going back to December 2023, it just imploded to the price of the yen where it was in December of 2023. That's the carry trade unwind. And when it gets ugly, it's a straight down unwind until all the guys who are over on leverage are completely annihilated. You don't know where that bottom is going to set. Take a look at what it does to the Japanese stock market. This is the Nikkei. Okay? This is the Nikkei. Japanese stock market's just collapsed. Down 12.5% today, which is the largest one-day decline since 1987. Just put that in perspective for yourself before you think about running out there and catching a falling knife. Something nefarious is going on. The market is staring into the abyss. Holding Treasury bills, Treasury bonds, and a little bit of gold is where I want to be in this market. I don't have to be the first guy into the breach. So that's step one about today. Take a deep breath, relax, and sit on your hands. There's going to be wild volatility. Okay? Figure out your risk tolerance and your goals before you start clicking keys on a keyboard. This is not a game. This is your net worth. You've worked hard for that money. Protect it first. Worry about capturing upside second. But I don't want to get to how I'm going to trade today. Let's talk a little bit more about what's happening with the market and why. So we got the carry trade unwinding. We have the chant now. After last week's Fed meeting, we have the chant. The Fed's behind the curve. The Fed's behind the curve. The Fed's always behind the curve. They always will be behind the curve. Okay? If Chairman Powell wanted to save us all the effort, and I would appreciate this, maybe he'll consider it in the future. Okay? Let's stop talking about, let's stop meetings where there's like a 45-minute conversation with journalists and they ask a whole bunch of questions and he tap dances around the questions and doesn't really answer the questions, blah, blah, blah. He could just come out there for the meeting with journalists and say, guys, I'm not cutting rates until the market forces me to. See you later. See you next month. That's what the Fed does. Sure, the Fed's going to cut in September. You know why? Because the market's going to crash. And then the Fed's going to cut rates. I mean, it's like that every time, guys. Who are we kidding? So these things are all stacking up. The yen carries unwinding. Now the chance the Fed's behind the curve. Why did it start last week? Let's keep looking at the layers, okay? This is the worst time of year. So everything's just stacking up against it, right? For a market collapse. This is the worst time of year. August, September, October. Every year we know those 3 months are treacherous. You don't know which one's going to be the most treacherous, but every single year. One reason is institutions close their books on bonuses and performance in September. If you're a fund manager, made a lot of money all year, and you're heading into a totally disturbing and unpredictable November presidential election, why would you hold on to your ass? Why? When you can own Treasury bills at 5%, why bother? You've already locked in your bonus. So once the chant starts, they start falling all over each other to get out of the market and book their profits. This is why NVIDIA is down 12%, Amazon's down 7%, okay? Apple's down 9%. We just heard Warren Buffett cut his stake in half. I mean, this is just classic August, September, October action. Now I'm gonna say something here, and let's talk geopolitically for a minute. And forgive me, this is not fear-mongering. This is just facts of the case I'm going to lay out for you because I think it's something you need to consider as this market unfolds. The market tends to know before horrific geopolitical events unfold. And the simple reason for that is that the people who are doing the event are shorting the market ahead of time. Example, airline stocks collapsed in August of 2001. And then we had 9/11. That was actually a pretty awful August in the stock market. And then we had 9/11. These are just the facts of the case. I don't know what's going to happen. But when I see the market destabilize like this, I have a memory. I remember August of 2001. I was living in Manhattan. I was working in Manhattan. I was working in Manhattan on September 11th. Okay. And I remember the stock market leading up to that. I'm just saying. So I had a friend of mine. I have a friend of mine in the DOD. We're just friends. And I shared this with you guys a couple weeks ago. Risk Monitor went red. He was a house guest. And he's a very intelligent guy. I mean, he's, security clearance type of guy. And he's just a lovely guy. And so I was just chatting with him. My question for him was, what is the biggest, because there's all these geopolitical events unfolding, what's going on in Israel, all this type of, all these very disturbing situations. And I was sharing what was, top of my mind. And I wanted to know what was on top of his mind and his colleagues. And he surprised me. He said the number one scenario that they're planning for is China walking into Taiwan. I said, come on, man. That's never going to happen. We were sitting out in the balcony, having a drink, relaxing, watching the sunset. I said, come on, China's never going to do that. And he laid out for me chapter and verse why that was the number one concern on his whiteboard and that of his colleagues. I'm not going to go over it with you right now. I'm just telling you that's what he told me. And then I watched the carry trade unwind aggressively in the Nikkei collapse. I'm just saying, what is the probability of that? I thought 0 before that conversation. Now I'm watching the Japanese market collapse. And I'm telling you it's the carry trade unwind. But why is the carry trade unwinding? I don't know. God forbid we find out in the future. So if I thought that was 0 probability 2 weeks ago, and I had that conversation with him, I said, okay, maybe it's a 3% probability. He thinks higher, but I was like, come on. And then I'm watching what's going on in the market, and I know the market knows ahead of time horrific world events. It's been like that my whole life. Now I'm wondering, should I put a 0 at my expectation? I had 3% as my expectation on that outcome before. Should it be 30? Because that's where he is. I don't know. I share that with you, not to fearmonger, but to make sure you're not whistling past the graveyard. Open your eyes to the risk. There are risks out there that are almost impossible for us to know. And this is a time to protect capital. Because I don't know about you guys, but I know there's a lot of people out there watch the market crash this morning and say, what a great buying opportunity. They'll be all over Twitter and all over X and Twitter, all over YouTube. That was a great time to buy the market's crashing. Oh, this is going to be great. Well, let them be in the breach first, right? There's a breach. Let them go through the breach first. Usually that guy's dead. Okay. I'll walk through the breach with the generals later. That's my comment to you today. Not to scare you, but to make sure you're aware of the risks that are around us. Okay. How about you guys? I don't know about you guys, but I know for me, the gremlins are going off in my head this morning. I'm just going to make a quick comment on this. Why do I not own VIX? Why am I not short the market? Hey, if you own VIX, if you're short the market, well done. I'm happy for you. Okay. That was a decision that had to be made 2 weeks ago. My risk tolerance, my goals, I'm a fiduciary. I manage other people's capital. I don't mess with VIX and I'm not shorting. We had a big year in the stock market. We booked our profits. We own Treasury Bills and Treasury Bonds. We own TMF, which is triple Treasury Bonds. We had a very nice morning. That's all I want. There's always going to be a gremlin in your head. You could have done more. Okay? You got to get rid of that gremlin. That gremlin just going to cost you money over time. And I won't be touching any of those things in here. We made some money short on this desk. We traded it short. I don't like to sleep on short. Book my profit. Let the market do what it wants to do. Carry trading. Will I be out there carry trading today? The carry trading strategy that I've developed for you guys, and we've been managing successfully together for over a year, is designed for a normal bell curve of volatility. This is not normal. So while there's huge upside potential, if we catch a rip, we have to recognize we're completely outside the realm of the strategy we built. So either A, I'm not trading today, and I'm just going to collect my interest in Treasury bills. Or B, if I trade, it's the smallest position size. I don't need maximum position size in volatility like this. I put on a 1-to-1. Market's down almost 4% on the S&P. If I just put a 1-to-1 position on and the market were to reverse and close flat on the day, I'd have a huge day. So I don't need massive risk. This is not a time for massive risk. So I will be out there looking for a carry trade. I may do it. It wouldn't be right off the open. Okay, something else I'll have to develop. But I may do it with you guys, but just be very clear, we are totally outside the bell curve that our strategy was created on. And so you could argue we shouldn't be in there at all. And if we are, small position size, because volatility has gone berserk. Okay. Let me see if there's anything else I want to chat with you guys about. I think that's it for today. And I'll be happy to take questions now. Question I'm getting from the Slack room. I still have positions on, I've been off the desk and I just came back. I still have positions on gold, Agnico Eagle, Newmont, and Wheaton. What are my thoughts? Sell at the open and hold. Okay. Okay. We sold all of our Newmont on Friday. Okay. We booked our profit on New. We bought it here, up there. We sold the whole thing. You're asking me, and of course I'm already out of Agnico. We booked our profit in here. And I never owned Wheaton, but it's just as good. They're all great. But let's look at GDX. Okay. So you're asking me what to do now. The reason we don't own on this desk any gold stocks right now. I own gold physical, which is down 1.8%, but I don't own the stocks. It's because I lived through 2008, the great financial crisis. And when I say to you that there is no rotation, when the market goes down, everything goes down. I really learned it back then. I learned it maybe even before that. Maybe in 2000, things are imploding. But whatever. Let's look at the great financial crisis. I was running a precious metals hedge fund at the time. My dad and I were. Okay. We made money, but at the end of the year, we made money. Okay. But when the market initially is collapsing, every asset gets puked out. It doesn't make a difference. Whatever's liquid, they're selling. People are getting buried over here. They're selling this to create liquidity to pay off margin balances. I can't tell you what to do with your positions. That's not my job. You have to be the smart money and make your own choice. Okay. So when you pose a question to me of what should I do now, let me first say we don't own mining stocks because when markets implode, they all go down. At the same time, I think that mining stocks might be one of the best places to be over the next 3 to 6 months. You might have to suffer this before that. I think mining stocks are at the top of my whiteboard. So whenever this settles out, I can't wait to buy mining stocks if the metal does what I think it's going to do. But I just own physical metal right now. And so I don't know your portfolio. I don't know how much risk you have on. I don't know if they're small positions or big positions. These are things you're going to have to answer for yourself. I generally, let me put it this way, if the stop is being hit, you raise cash. I mean, it's not a debate for me on my desk. So wherever your stop is, if it's going through the stop, now you're asking me, do I hold it this morning? Do I sell it in the afternoon? Man, come on. You're going to have to make those choices yourself. I don't know any more than you do. Market could bounce, market could open and close higher by the end of the day. I haven't the slightest idea, and I don't have a crystal ball. On this desk, we generally wait till 11:30 before we execute a stop. And sometimes I execute a stop at 3:30. That means it goes below my stop on horrific days, but then there's other days where I'm still on a trade and I get to sell it higher. So you have to make that choice on your own. And depending on the size of your position, it becomes more important or less important. And don't forget this idea. You could break your order in pieces. You could sell a piece right away to cut down your emotion and your risk, see where the market is over the next couple hours, make more decisions. So it doesn't have to be an all or nothing thing. That's the best I can answer on that question. And that would be true for anybody with a position in the market as it's imploding. It sucks, but stop trying to guess what the market is going to do and execute your strategy. Is it going through the stop? I don't care if it's a gold stock or whatever you own. Is it going through the stop? Yes. How do you want to execute to protect yourself? Sometimes you have to bite the bullet and get out of Dodge to protect yourself. Other times it closes higher at the end of the day. And if that drives you crazy, then you don't make it an all or nothing decision. You take a piece out to reduce your risk. You watch how it's behaving. Then you make your next step. You read and react to what the market's telling you. All right. Can VIX go crazy? Can VIX go? VIX is going crazy, right? It just doubled overnight. So there's the question on VIX that I knew somebody was going to ask me. Okay. VIX has been stealing money from people for years. And then every now and then VIX does this. It's a lottery ticket thing. During Volmageddon, when VIX went from 25 to 50, it was on its way to 150. I am not a VIX player. I am not interested in VIX. If I wanted to benefit from the market going down, I would simply short the market, short the indexes. I know Silver Fox is out there short Tesla and Nvidia. So that's where I would go. I want liquidity. I want assets that I understand. Okay, but those positions had to be set up 2 weeks ago when the risk monitor went red. That's when you put a short on if you want. If that's your risk tolerance, your goal, and you want to short, it's 2 weeks ago when the risk monitor goes red. It's not now when the market's imploding. So I don't know how to answer the question. The last time we had Volmageddon, VIX went to 50 to 150. So it could do that again. I haven't the slightest idea. But I'll tell you one thing. There were a lot of smug people who've been writing VIX for years now. And they're getting buried today. You know, and I know those people who keep making money selling vol. And they keep making money selling vol, and it becomes like an addiction. And so, you know, I was having this chat. This one guy was a lovely guy. I hope he's not totally bankrupt by now. But this is how bad it was. He's like a real estate guy from Canada, and he comes down here, and he's a good guy. And I was chatting with him over a whiskey, and there's a real estate guy. He's a big real estate guy, and he starts preaching to me. This was a couple months ago. He starts telling me how great it is to sell volatility. He makes 20% a year doing it, and you know he dedicates X amount of percentage of his portfolio to it, which to me was like, I'm looking at this guy saying, "You out of your fucking mind? You're putting that much into writing volatility?" So I said to him, "Well, what's your exit strategy when VIX goes from 12 to 25? Oh, you know, every now and then it does that, and I take a loss that month, and I just go do it again because it always goes down. It always works." They're going to carry those guys out in body bags. because I mean, he's getting killed this morning. And I guarantee in his mind, he's thinking, oh, I'm going to go sell some more volatility. This is great. So it gets out of hand in volatility until those guys are carried off the trading floor. I don't know where that's going to end up, you know. Mo, happy to do it, man. Happy to have it. Any questions you guys have before I wrap up? The market's going to open in 3 minutes. Bitcoin's down 20%. I guess that argument's over, that Bitcoin is like gold and it's a protector of capital. It's not a protector of capital. It's not decentralized. It's owned by a bunch of whales and governments. And this is what you get when you create ETFs. Total annihilation. Oh, is that Ether? Ether's down 27%. So crypto is just getting destroyed. Crypto is a risk-on asset. You know, when people want liquidity, that's what it is. Okay. No more questions. Nothing you got for me. You can always put into the comment section of this video a question during the day. I'm going to monitor the video in YouTube so I can answer questions if you got them during the day. I hope you all are safe. I hope certainly ARMR insiders, you know, we're in a perfect position here. I mean, the alpha in our portfolio has just gone berserk. You know, the alpha in our portfolio has gone berserk just by sitting still right now and owning Treasury bills and Treasury bonds. So we don't have to do anything today, but I will. The only thing I'll be looking to do on my desk today is harvest some of that alpha by getting long the S&P. That's the only trade I'm looking for today. And I'm happy to trade with you guys. We'll get started in 3 minutes. I got to get out of here to get that live stream going. So ARMR insiders, check the Slack room. I'll post that in a minute. Everybody else, be safe out there. I hope you have a wonderful trading session. And guys, remember, at the end of the day, think about your strategy, execute that strategy, and you have to be the smart money. You can't rely on anybody else. All right? Take care, guys.